What if I told you that the difference between a stagnant bank account and a growing fortune isn't about luck? It's about systematic behavior. With AI and high-frequency trading creating a constant noise in the market, the real secret to building wealth lies in your investment habits. The way you approach investing, your mindset, and your daily actions can either propel you forward or hold you back. In this video, I'm going to show you the 8 investment habits that will not only protect your money, but make it grow exponentially over time. These are the habits that set the wealthy apart from everyone else. Stick around to learn how you can adopt these behaviors for lasting financial success. 1. The pay yourself first autopilot. One of the most powerful habits that can transform your finances is treating your savings like a non-negotiable bill. Too many people wait until the end of the month to save, often leaving little to no money for investing. But what if you flip the script? When you pay yourself first, you make saving a priority rather than an afterthought. Setting up an automatic transfer to your brokerage account the same day your paycheck hits ensures that your money is invested before you even see it in your checking account. By automating this process, you remove the temptation to spend what you earn, making investing part of your routine. Whether it's 5%, 10%, or 20% of your income, automating your savings guarantees that you'll consistently put money towards your future without even having to think about it. 2. Aggressive fee auditing. In 2026, even a seemingly small management fee can eat away at your potential gains over the long term. Many investors fail to realize that fees, even as low as 1%, can reduce their returns by as much as 25% over the course of 30 years. That's why making it a habit to audit your investment fees is critical. The first step is to check the expense ratio of every fund you own. Aim for low-cost index funds that charge fees below 0.05%, such as VO or VTI. These funds offer broad market exposure, a fraction of the cost of actively managed funds. Regularly reviewing and comparing the fees on your investments ensures that you're not losing money to unnecessary costs. By choosing low-cost options, you ensure that more of your money is working for you instead of being swallowed by fees. Taking time to audit your investments and shift your capital to more efficient options is one of the easiest ways to increase your long-term returns without having to increase your investment amounts. 3. The rule of 24 for impulse buys. One of the most challenging aspects of growing wealth is controlling impulse spending. With the rise of one-click shopping and marketing designed to trigger emotional spending, it's easy to fall into the trap of unnecessary purchases. But what if you could make smarter, more intentional decisions? The rule of 24 is simple yet effective. Before making any non-essential purchase over $100, wait 24 hours. This brief waiting period breaks the dopamine-driven cycle of instant gratification, giving you time to assess whether the purchase is truly necessary or if it's simply an impulse. By applying this rule, you give yourself the mental space to reflect on whether the item or experience is a true value add to your life, or if the money could be better invested elsewhere. Over time, this habit will not only reduce unnecessary consumption, but also build discipline around spending. Instead of mindlessly spending on fleeting desires, you'll have the clarity to focus on investments that support your long-term goals. 4. Strategic rebalancing, the buy low hack. Investing isn't a one-time effort. It requires ongoing attention and adjustments to ensure that your portfolio remains aligned with your goals. That's where strategic rebalancing comes in. Set a reminder on your calendar every 6 months to check your asset allocation. If one part of your portfolio has grown substantially, such as stocks making up 90% of your holdings when you initially intended them to be 80%, it's time to take action. Sell off the excess and move it into underperforming areas like bonds or international stocks. This forces you to sell high and buy low, which is a key to capturing market opportunities and avoiding overexposure to a single asset class. Rebalancing regularly ensures that your portfolio stays diversified and that you're not taking on more risk than you're comfortable with. It also helps you lock in gains from market growth and shift capital into areas that have the potential for greater returns. By automating this habit and setting regular reminders, you turn rebalancing into a proactive, low-maintenance strategy that ensures your investments continue to work for you. 5. Maxing out tax-sheltered buckets. Tax efficiency is one of the most powerful tools in wealth building, yet it's often overlooked. In 2026, Tax drag is one of the biggest silent killers of long-term compound interest. The solution? Maximize your contributions to tax-advantage accounts like Roth IRAs, 401(k)s, and health savings accounts, HSAs, before you touch any taxable brokerage accounts. These accounts allow your investments to grow tax-free or tax-deferred, which means you get to keep more of your returns over time. Prioritizing these tax-sheltered buckets ensures that you're taking full advantage of the tax benefits available to you. For instance, with a Roth IRA, you contribute post-tax dollars, and your withdrawals in retirement are tax-free. This tax-free growth is a huge advantage over time, especially for younger investors who have decades for their investments to compound. Making this a habit ensures that you're paying as little in taxes as possible, giving your money the best chance to grow and work for you. 6. Ignoring the financial noise cycle. In today's world, the financial news cycle is faster and louder than ever. With the constant barrage of market news, political shifts, and economic updates, it can be easy to get caught up in the noise and react impulsively. However, research shows that the more often investors check their portfolios, the more likely they're to panic sell during temporary dips or market volatility. This behavior can derail long-term growth, as it leads to poor decision-making based on short-term fluctuations. To counteract this, make it a habit to check your portfolio less frequently. Instead of reacting to every market update, focus on your long-term goals and strategy. The best investors are those who tune out the noise and stay focused on their investment habits, trusting that their consistent, disciplined approach will pay off in the long run. By ignoring the financial noise cycle, you'll be able to make clearer, more rational decisions that align with your long-term wealth-building goals. 7. Dividend reinvestment drip. Dividends are a great way to generate passive income, but you don't want to let your dividends sit idle in your account. Instead, enable the dividend reinvestment plan DRIP on your brokerage account. DRIP automatically uses your dividend payouts to purchase more shares of the stock that paid them. This creates a snowball effect, where your dividends start working to generate even more dividends, compounding your wealth over time. For long-term investors, DRIP is one of the most effective ways to grow your wealth without needing to actively invest more money. By reinvesting dividends back into your portfolio, you increase your exposure to the stocks that are already paying you, allowing your income to grow exponentially. Over time, this compounded growth can lead to substantial gains, especially when combined with other smart investing habits like rebalancing and tax-sheltered investing. 8. The upskill and invest feedback loop. Wealth building isn't just about saving money. It's about increasing your income. The upskill and invest feedback loop is a habit that can supercharge your wealth-building efforts. Set aside time each week, just 2 hours, to learn a new high-value skill. This could be anything from learning how to implement AI in your industry, developing specialized consulting services, or even diving into a completely new field that excites you. As your income increases, it's important to keep your lifestyle creep under control. The more you earn, the more you might be tempted to increase your spending. However, by keeping your lifestyle relatively modest, you can funnel your additional income into investments, allowing your wealth to grow exponentially. The key to this habit is the feedback loop. As your skills increase, your income rises, and with higher income, your investment contributions soar. This habit ensures that you're constantly growing your financial potential and that your increased earnings continue to work for you. There you have it, the top 8 investment habits that grow your money long-term. By adopting these habits, you'll be able to build a solid foundation for wealth that doesn't rely on luck or short-term market gains. Wealth isn't just about what you save or invest. It's about the consistent, disciplined habits that you build over time. If you found this video helpful, don't forget to like, share, and subscribe for more tips on building long-term wealth. Let me know in the comments which habit you're most excited to implement, and I'll see you in the next video.